Alright, so let's talk about Roku because this is one of those stocks that people either love, hate, or don't understand at all. Most investors look at Roku and think, oh, that's the company that sells streaming sticks and cheap smart TVs. But that's not the real business. Roku is actually fighting a much bigger war, the battle for the living room, the TV home screen, and the future of connected TV advertising. So in this video, we're doing a complete long-term breakdown of Roku stock for a 2026 investment horizon. We'll cover what Roku really does, why investors are still interested in it, what the biggest growth drivers are, and most importantly, the risks that could turn this into a value trap. And yes, I'm going to be straight with you. Roku has upside, but it's not some safe blue chip stock. It's a high-risk, high-reward kind of setup. Let's get into it. Quick reminder. This video is for educational purposes only and is not financial advice. Always do your own research before investing. So first, what does Roku actually do? Roku has two main business segments. The first segment is devices, meaning streaming players, streaming sticks, and Roku TVs. That's the part most people see. It's physical, it's visible, and it makes Roku look like a hardware company. But here's the truth, the device business is not the real money maker. In fact, Roku often sells its devices at low margin or near break-even, because the goal isn't to make huge profits from hardware. The goal is to get users into the Roku ecosystem, because Roku's real business is the second segment, the platform business. The platform segment includes advertising, content distribution, subscription revenue sharing, and Roku's own content hub called the Roku Channel. And this is where Roku's entire strategy makes sense. It's a classic model. Get the user through cheap hardware and then monetize them for years through advertising and platform revenue. So Roku is more like a connected TV advertising platform than it is a hardware brand. That's the foundation of the entire Roku investment thesis. Now let's talk about why investors still care about Roku. Because even though the stock has been volatile and the company has faced tough years, the long-term opportunity is still real. The biggest reason is connected TV advertising. Traditional TV advertising is expensive, hard to measure, and honestly, outdated. Advertisers want targeting, they want tracking, they want performance data, and connected TV advertising or CTV advertising gives them exactly that. The world is slowly moving away from cable and towards streaming, and the advertising money is following attention. And this is where Roku sits in a very powerful position. Because Roku isn't trying to be a content company like Netflix. Roku doesn't need to spend billions making original shows to compete in the streaming wars. Instead, Roku wins by being the platform that connects viewers, streaming apps, and advertisers. The home screen is a huge part of that, because when you turn on a Roku TV, you land on the Roku home screen. And controlling the home screen is like controlling the entrance gate to everything. Now, another big advantage for Roku is the Roku Channel. The Roku Channel is their own free streaming hub, and it's designed to increase watch time and create more ad inventory that Roku directly owns. That's important because it means Roku isn't fully dependent on other streaming apps for monetization. If Roku Channel keeps growing, that becomes a major long-term profit engine. And this connects to one of the biggest trends happening in streaming right now, FAST. FAST stands for Free Ad-Supported Streaming TV. Basically, it's streaming content that feels like traditional TV, but it's completely free for the consumer and monetized through ads. And honestly, FAST could be one of the biggest winners in the streaming world by 2026, because consumers are hitting subscription fatigue. People don't want to pay for 10 different subscriptions anymore. And in tighter economic conditions, free streaming becomes even more attractive. So, if FAST grows aggressively into 2026, Roku is positioned perfectly because it is already built around the ad model. Now, let's be real for a second. Roku is competing against giants. Amazon has Fire TV. Google has Android TV and Google TV. Apple has Apple TV. Samsung and LG have their own operating systems too. So how does Roku survive? Roku's biggest competitive advantage is that it's neutral. Unlike Amazon or Apple, Roku isn't pushing a massive ecosystem of smartphones, cloud services, and retail platforms. That neutrality makes Roku attractive as a partner for TV brands, streaming services, and advertisers. Second, Roku has scale and data. Roku gets access to viewership behavior data, what people watch, how long they watch, what they search, what they click, how ads perform. And in the advertising world, data isn't just a nice to have. Data means better targeting, better measurement, and better ad pricing. Third, Roku has strong distribution through TVs. Instead of needing you to buy a Roku stick, Roku gets built into smart TVs. And the more Roku-powered TVs that exist, the more locked-in households Roku owns. So Roku becomes less like a device company and more like a built-in operating system business. Now here's where we have to talk about the part people avoid. Roku is strategically powerful, yes, but financially, Roku has struggled with profitability. The biggest reason is that Roku is highly dependent on advertising cycles. If the ad market is strong, Roku performs well. If the ad market slows down, Roku feels it immediately. Advertising is not stable like subscription revenue. During economic downturns, marketing budgets are one of the first things companies cut. And that makes Roku's revenue growth more volatile than many investors prefer. So if you buy Roku, you are not buying a predictable cash flow machine. You are buying a long-term bet that connected TV advertising will expand and that Roku will execute well enough to become sustainably profitable. That's the deal. So what needs to happen for Roku stock to really perform well into 2026? First, Roku needs to expand platform monetization, mainly through ARPU, average revenue per user. Roku doesn't need millions and millions of new users if it can earn more revenue from each user through better ad technology, stronger targeting, and higher engagement. Second, international expansion is a big opportunity, but it needs to be done carefully. International markets can grow Roku's user base, but international expansion can also burn cash quickly if not managed properly. So Roku needs disciplined growth. Third, Roku's ad tech and measurement tools need to improve. Advertisers pay more when results are measurable. If Roku strengthens ad measurement, it can charge more per impression and improve its ad economics. And finally, Roku needs to prove operational efficiency. In today's market, growth alone isn't enough. Investors want profitability. If Roku shows a clear path toward narrowing losses and improving cash flow, the stock could re-rate upward because investor confidence returns. Now let's talk risks because Roku is not risk-free. The first major risk is competition. Roku is fighting trillion-dollar companies. Amazon and Google can afford to operate at low margins forever. Roku cannot. Second, ad market weakness remains a threat. If advertising demand stays soft heading into 2026, Roku's upside could be limited. Third, there's content cost risk. Roku Channel is a great asset, but if Roku spends too aggressively on content, profitability could suffer. And fourth, Roku has to balance monetization with user experience. Too many ads can ruin the platform experience. If engagement drops, monetization also drops. That balance is critical. Now I want to hear from you. Are you bullish or bearish on Roku for 2026? Drop your thoughts in the comments. And if you enjoyed this long-term breakdown, hit like and subscribe because I'm covering more US stocks with real deep dive analysis. Thanks for watching and I'll see you in the next video.